Trading options around a company's earnings events can be hit or miss. There are huge profits that can be made if you know what you're doing, and if you don't, there can be huge losses. In this video, we're going to cover what are the different strategies to trade options around earnings, the advantages and disadvantages of trading options on earnings, what is the safest earnings option strategy, and how do we place an earnings option trade on the option trading platform. And then we will finally talk about one of the best earnings option trading strategies that no one really thinks about that happens right after earnings. Hey guys, Darren here. We've got a great video for you here today. However, before we get started, if you appreciate the time and effort that goes into making videos like this, all I ask is that you please hit that like and subscribe button. It really helps out the channel, so thank you very much. I think it's important that we understand all the different strategies that the rich are using to get richer. We want to be able to use those same strategies so that we can profit in any market. Be sure and download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. Guys, why do you think people like trading options around earnings? Because you can make a lot of money quickly if you get the trade right. Who doesn't want to make a quick buck? What are the different strategies to trade options around earnings? There are several different option trading strategies that can be used to trade around a company's quarterly earnings events. We can sell strangles, iron condors, vertical spreads, puts, or calls. Some people are so confident in a company's earnings that they even buy call options in hopes of a huge upswing in the stock price. I'm going to cover one of the most popular and safest options earnings strategies in this video and show you exactly how to place the trade on the option trading platform. However, first let's discuss the advantages and disadvantages of trading options on earnings. First of all, there's high IVR. When earnings are about to occur, the IVR, which stands for implied volatility rating, of a particular stock is much higher than where it is after earnings. This is because there's a much greater chance that the stock price will make a big move either up or down following the earnings report and conference call. Every quarter, public companies report earnings to their shareholders and the public in general. There's typically a conference call as well as the CEO and CFO speak and answer questions that the analysts ask. When earnings and revenue top the expectations, the stock price often moves up, and when it falls short of expectations, the stock price typically drops. However, this is not always the case. Sometimes it actually does the opposite. The company can issue guidance for the future that doesn't meet expectations, or there can be a question that isn't addressed the way that the market would like to see it. There could be news and a multitude of things that can move the stock price in either direction quickly. So with higher volatility, there is a greater chance that the stock price moves quite a bit. What does that mean? Because there's a greater chance of stock price movement, the option premiums are much higher. So if we're selling options, it can be an advantage since we collect more premium. However, if we're buying options, they are more expensive, which can be a disadvantage. But if we're correct in our direction, the reward can be big. So in general, trades just prior to earnings can result in fast profits, which can be very advantageous. If we're incorrect, we can have some pretty big losses as well. However, if we can roll to the following month and make up for some of those losses, it will greatly benefit us. What is the safest earnings option strategy? The safest earnings option strategy, in my opinion, is the iron condor. Why the iron condor? Because options are almost always perfectly priced. There has to be a buyer for every seller, and there has to be a seller for every buyer. So everything is baked into the price of the options. The technical charts, fundamentals, including the income statements and balance sheets, news, management, and just everything. So for the most part, it's almost a 50-50 coin flip if the stock price will move up or down. Even the CEOs don't typically know. Sure, the market moves up over the long term at 7 to 10% per year on average, sometimes more and sometimes less. However, that's even baked into the options pricing with what is called volatility skew. So for all these reasons, I think it's safest to use a non-directional or neutral trading strategy. We could use a strangle. However, an even safer bet is an iron condor since it incorporates buying protective puts and calls, which can save us from a big move should it happen post earnings. How do we place an earnings option trade on the option trading platform? Let's open up the option trading platform. You can do this on any platform or brokerage. However, Tastytrade is one of the best and most intuitive for trading options. These are the guys that developed the TOS, Think or Swim, option trading platform and then sold it to TD Ameritrade. TD and Schwab use this platform still to this day. Tastytrade is even better. Use the link below and you can get cash back when you open an account. I recommend that you open with at least $5,000 so that you can make several different trades. Everyone knows the company and stock NVIDIA these days as they are the biggest name in chip stocks and AI right now. NVIDIA has earnings on Tuesday, November 21st after the closing bell. We punch in ticker NVDA in the upper left while on the trade page in the table mode on the Tastytrade platform. We see that IVR is 42 and stock price is 492. If we look to the far right, we can see the IVR for the different expiration dates. Notice the November 24th chain on the far right has a 72 IVR. This is because it is right after the earnings on Tuesday the 21st. We click on the November 24th chain to open it up. We then click on the bid to sell the 450 strike and ask to buy the 460 strike put. This forms the put credit spread and we collect $1.48 to sell this spread. As you know, this is really $148 since one option contract controls 100 shares of stock. We then click on the bid to sell the 540 and the ask to buy the 550 call options. This sells the 540-550 call vertical spread and adds another $145. So in total, we collect $293 for selling this $10 wide iron condor. We click on the curve and see that our POP or probability of profit is 77% and we are profitable anywhere inside the green zone. The first inside set of dashed lines are the one standard deviation lines. The stock price theoretically is expected to stay within that one standard deviation range 68% of the time. We are even better than that since our spreads are outside of that one standard deviation expected move. Since we have a 77% probability of profit, that means we only have a 23% chance of not being profitable. Earnings will be announced on Tuesday the 21st after the bell or the close. So this means that any big move, or hopefully not, will likely occur at the open on the morning of Wednesday the 22nd. If the stock price stays within the profit range, we will be profitable and can immediately close the trade. This is because the IVR will be collapsing and there will only be 2 more days until the expiration on Friday, November 24th. What if the stock price moves outside of the profit range? Now, if the stock price does move outside of our short strikes and profit range, there's something that we can do which I find works very well. We can immediately roll out in time to the next regular monthly expiration date and recenter our strikes around the new price to collect additional option premium. This would be the November 15th chain. However, on Wednesday the 24th, there will only be 23 days to expiration in December. So I'll likely just go ahead and roll to the January 19th chain and collect even more premium. The IVR will still be in the process of collapsing right at the open on the morning of Wednesday the 24th. So the open will be the best time to roll and recenter for the additional credit since we collect more premium in higher IV. Now that we know how to recover an iron condor that went astray and the price moved outside of our range, let's look at a very similar trade. This is one of the best earnings option strategies that no one really thinks about. It's right after earnings. If we really think that there's going to be a big move on earnings and that the stock price is likely going to move outside our range, this is a way that we can make profits. It's an after earnings trade, and this has proven to be profitable for me over time. Let's say NVIDIA missed earnings or the guidance for the next quarter was bad and the stock price dropped big. I found that if this happens, IVR will still be fairly high in the process of dropping right at the open. So we can place an iron condor trade right at this time and collect good premiums. Since the stock price dropped big for a reason, it will likely not drop too much more over the following months since it's already done. At the same time, it likely won't jump back up quickly either. This is specifically due to the reason that it dropped. It didn't drop for no reason at all. If the stock price jumped up on good earnings or guidance, the same rules apply. We can sell an iron condor in this situation as well. Due to the good news, the stock likely will not drop within the next month. It also will not likely move too much higher either since it's already just made a big move. All right, guys, some of the key takeaways. Selling an iron condor outside of the 1 standard deviation range can be one of the safest earnings option trading strategies. We can immediately close winners for a quick profit and roll and recenter losers to the next month to collect additional premiums. We can also have great success selling iron condors after earnings for profitable trades. All right, guys, lastly, if you plan on selling this NVIDIA iron condor, please do it right before the end of the day on Tuesday, the 21st. If you do it right before the close, you can center your strikes and be right in the middle of the profit range. Be sure and keep your eyes out for part 2, the follow-up video. I'm going to sell this iron condor and hopefully profit and show you the win. If not, I'm going to likely roll to the next option trading cycle and collect additional profits. I put links down below for several items, including the free options workshop. Be sure and grab that. Remember to hit like and subscribe, share the video with a friend, leave a comment, let me know what you're trading, what you are having success with, and I reply to all comments. Thanks for watching. See you in the next one.